Hello and welcome back to Never Change. Here I intend to go through an analysis of GameStop, but also go through some of the mechanisms at play at what brought GameStop into the limelight and caused the stock price to shoot up by such an incredible percent. So let's get started. So why GameStop? So GameStop has become quite prominent at the moment because of the battle between the hedge funds shorting the GameStop stock and Wall Street bets, retail traders trying to create a short squeeze against the hedge funds and succeeding. So GameStop was heavily shorted to about 140% of its outstanding shares. How that's possible, God knows. And from early January to late January, the retail investors were able to put a short squeeze on, and the stock price jumped over a 16-day period by 2,290% if you go from what the stock value was early January, around $20, all the way up to $480 before it came back down. So what is short selling? So short selling is when a position is opened by borrowing shares of stock that the investor believes will decrease in value. The investor sells these borrowed shares to buyers willing to pay market price. The borrowed shares must be returned. The trader is betting that the price will decline and they can purchase them at a lower cost and pocket the difference. So to take through an example, so in this scenario, trader shorts XYZ stock, which is currently trading at $50 a share, and the trader is betting that over the next quarter the share price will go down. So the trader has an inkling they're going to have a bad quarter. So the trader borrows 100 shares and then sells them to another investor. The trader is now short 100 shares as they have sold something in essence they didn't own. So in this scenario, let's say the market went the way that the trader wanted. So a month later, the stock drops to $40 due to a poor financial quarter. The trader decides to close the short position and buys 100 shares for $40 on the open market and replaces the borrowed shares. The trader profit on the short sale, excluding commission and interest, is as follows. So original $50 minus the new price, which is $40, which equals $10. $10 times the 100 shares that they took out leaves the trader with $1,000 in profit. So let's go back over this a different way. So let's say in this scenario the price increased by $15, so the new share price is $65, and the trader decides to cut losses and closes the short position at $65. So the loss would be on the scale of the following. So original $50 minus the new stock price, which is $65, which is negative 15, times the 100 shares is negative 1,500, so would be a loss. So what is a short squeeze? So a short squeeze is a phenomenon that occurs in the stock market when the short sellers of the stock are forced out of their positions or forced to make margin calls due to a sharp increase in the share price. So this is usually triggered by unexpected good news, but in the case of GameStop, it was triggered by retail investors pouring their life savings into a stock that they wanted to save and not want to see shorted into bankruptcy. So yeah, shorting carries a lot of risk. So, and one of the most outstanding features of the whole scenario for me was the fact that GameStop was shorted more than 100% of its share float, so its outstanding shares. And that can happen because a trader shorts the stock, so borrows shares, sells them onto another trader who then also shorts. And according to financial analytics firm S3, at GameStop's peak, short interest was 141.8% of its outstanding shares in January, on January the 4th, which is crazy in itself. So let's go through. So what is GameStop? So let's jump into a stock analysis. So GameStop is an American video game, consumer electronics, and game merchandise retailer. The company is the world's largest video game retailer, operating approximately 5,500 stores throughout the US, Canada, Australia, New Zealand, and parts of Europe. The company was founded in Dallas and took on its current name on 1999, and it also operates under GameStop, EB Games, ThinkGeek, Micromania, Zing. So it employs about 14,000 people full-time, 22,000 plus people part-time. It's headquartered in Grapevine, Texas, and has a revenue, as per the 2021 results, of just over 5 billion. And the CEO is George Sherman, who has been in post since April 2019. So let's deeper dive. So let's have a look at the credit rating, which is not great. So it currently stands at B- on the S&P, which would be regarded as very vulnerable and significant speculative characteristics. Currently is able to meet its financial commitments, but faces major ongoing uncertainties and could lead to inadequate capability to meet its financial commitments. So not great and not good if you want to borrow. Let's go through a common size analysis. So revenue is not great, it's trending down. It was trending down even before the pandemic, but the pandemic seems to have sped things up, which, if your business is predominantly high street retail, it's not only going to be GameStop that is struggling in these times. Cost of goods is also trending up on percentage terms of revenue, and that's probably, like hazard a guess, is because the cost to make your stores COVID secure, the ones that can actually remain open and keep your staff safe with extra PPE, has probably cost more to provide the goods and services that GameStop provide. Other things to take note of, so also not a great indicator, is that their operating income has gone negative. So it went negative 14 million in 2020 and now negative 254 million in 2021. A good point to make though is they are still managing to get the debt in order, because the interest expense that they're paying on a annual basis is dropping, so that is a good indication. But their pre-tax income is negative, as well as their net income is also negative, but trending up. So it minus 10% in 2019, and now only minus 4% in 2021. So even though it is negative, it's heading in the right direction. Analyst consensus around earnings, so missed Q2 and Q3 of 2020, beat Q4 of 2020, and very marginally missed the Q1 21 result target. So hanging in there, and the financials show what the common size analysis shows as well, that their revenue is declining. They're negative on earnings, but hopefully trending up. Moat analysis also doesn't show a pretty picture. So EPS can't do because it's negative. Operating cash flow per share is reduced about 18% per annum over a 4-year period. Revenue over a 4-year period is reducing by 14% on average, and book value per share is reducing by 25% over a 4-year average. Not great. Return on equity, return on invested capital, and debt. So minus 19% on return of equity, and minus 33% on return on invested capital. And the debt, because they're negative income, your debt to earnings ratio doesn't work, because theoretically they can never pay it off. So margin of safety. So I've had to go back to 2018 in order to estimate what this company's worth and what a margin of safety would be. So stats here are very speculative, and it spat out a company value of around $5.30 a share, with a 25% margin of safety of $3.98 a share, and at 50% margin of safety, $2.65 a share. Very different to what it's actually trading at today. So okay, let's see what the foundations are like. So eight pillar analysis. Can't do PE ratio because it's negative, minus 4%. Profit margin. Revenue is not growing, profit is not growing. Revenue is not growing, profit is growing, but it is negative. And outstanding shares are increasing. The current assets to liabilities, liability stands at 82% of their assets. So yes, assets are greater than the liabilities, but they stand at a very high percentage of. Free cash flow has been decreasing, but from last year to this year they went from negative 453 million to 64 million. So the last year to this year is heading in the right direction, and based off their current share price, which at the time of filming this was $186 a share, which gives them a market cap of just over 13 billion, the price to free cash ratio was 204. Now I won't go through the margins of safety because they bear no reality on where this company is at the moment. So risks to consider. So the credit rating is not great. The parameters would indicate that this stock is massively overvalued. The revenue is trending down over the past 4 years. Net income is trending up but still negative. Return on equity, return on invested capital are both negative, and also it exists in a depreciating sector. So high street retail is suffering even more within the pandemic, but it was suffering before the pandemic. So this company has to modernize itself. It has to change how it operates and not solely be reliant on the high street. Positive things to take away. So there are some. Free cash flow is now increasing from last year. Like I said, it was negative 493 million, now positive 63 million. It still has quite a bit of cash in hand or cash equivalents, standing at 508 million. So even though their net income is negative 250 million, it can still survive a bit longer. It still has quite a large asset base, which is 2.4 billion, and I think that's predominantly because they have 5,500-ish stores and probably own them. The liabilities, those do stand at 2 billion, so it's quite not a great assets to liabilities ratio. And I think, well, like I said before, the one thing that's keeping them alive is that the fact that they have quite a large retail investor following that keeps supporting the stock and buying the dips. So yeah, so as long as that keeps going on, you know, there's hope for the company. Yeah. So in conclusion, so would as a value investor, would you invest in GameStop? You probably wouldn't. You know, there's so many indicators that this company is struggling. There's also indicators that it could possibly weather the storm, but it's still going to be in the same position it was post pandemic. So, you know, I wanted to do this just to show that it's easy to get carried away in the hype, and you know, all of your friends say, no, this, you've got to jump into this stock, you know, it's going to moon, it's going to make you rich quick. But if the minute you start doing the due diligence, you can understand the risks around it. And then if you're still willing to invest after that, then, you know, hats off to you, go for it. You know, if you say, well, no, you've missed something, you've missed this, and this is what's worth investing in, you know, so go for it. Yeah, and there's also, you know, more importantly here, I think there's the, I touched on it before, it's the ethics question. I mean, at the end of the day, this company employs full and part-time 35,000 people, and these hedge funds colluded together and shorted the life out of it, and then started to put out on, you know, go on the news and say this company's at risk and put reports out, and, you know, in essence try to tip it over the edge and drive the price down as much as possible, which could in fact have, you know, bankrupted the company. And there's got to be an ethical question about that, because, you know, if that is, you know, if what they're saying, you know, the way, you know, the Wall Street bets guys colluded together in order to, you know, boost up the price, well, if that's wrong, you know, colluding together to try and drive the price down, it must also be wrong. You can't have it both ways. So and then just, you know, to put it all into perspective, within a 2-day period in January, the short sellers that still held on to their shorts lost approximately 1.19 billion just in 2 days. And then over the whole month of January, I think it was, I'd have to check it, but I think it was up about 19 billion lost. You know, some hedge funds lost even half their value. But at the end of the day, you know, if you're going to do, you know, trading, there's no guarantees. If you're a short seller, there's no limit to the amount of losses you can incur from short selling. So, you know, your capital is at risk, and, you know, do your due diligence. So, thank you for stopping by. Hope for this was helpful. This is a bit of fun, really, rather than a would you invest in this stock from a value perspective. Hope you found it helpful. Yeah, please feel free to comment, and if you think of a stock that you'd like me to analyze in the way I do, please let me know. Thank you and goodbye.